All right, everybody, having that hangover from Thanksgiving. Today, we're going to get right into some fun stuff. Greetings, everyone, and welcome to today's show, Benefits with John Clay. I'm John Clay, your host and chief strategy guide. Welcome again to the last day of November, first week of the Christmas season, if you will. Everything is good here. Hope everything is well with you there. Today's show is all about something that's very seldom explained, but often used as a weapon. I'll call it a weapon to impact your medical plan renewal. And we're talking here about incurred but not reported. And IBNR. Quick shout out to our plan sponsor. Our show sponsored is today by none other than Better Source Benefits, www.bettersourcebenefits.com. Reach out and check us out there on the web. And thank you, Better Source Benefits, for providing benefits, options, and solutions to employers across the country. So let's get back into it. Last show we were talking about practicing gratitude and doing that for better health and well-being. Today we're trying to refocus a little bit more on the business side of things because it is renewal season. It's Q4. January 1 renewals are out. Everybody's looked at them by now, especially in the large group market, but it always is good to have a little review on what you've seen because, folks, let's face it, we've talked to employer groups who've been buying benefits for 30 years and have no real idea what IBNR is. Incurred but not reported. And it has a huge impact when they want it to, especially on the fully insured side, to drive up the cost of your medical renewal. Why? Well, let's get into it because we're going to explain a little bit about what IBNR is, incurred but not reported. So in insurance terms, IBNR is such an important but often ignored concept, or it's misunderstood as well. So what exactly is it and how does it work? If your company is insured through the traditional Blue Cross, United, Cigna, Aetna, Humana, large group outfit, it's very likely that you've not heard it, or if you have heard it, they really didn't dwell on it much when they give you your renewal reporting. It's crazy because they if it doesn't benefit them, they don't say anything. If it does benefit them, then it's, oh my goodness, there's a huge IBNR charge out there, and we're going to get into it. So it's what we've seen it being used for is justification for a rate increase. Hello? It's always in their favor. IBNR works against you, Mr. Employer, but it works in favor of the insurance companies because it justifies their rate action, right? And this is, again, one of these ambiguous concepts that manages to have a major impact on your insurance program. And so when we're talking about this is so we're going to break down the definition of IBNR, incurred but not reported. What this refers to is the estimate of the liability from claims that have taken place but have not been reported to an insurer. While the carriers do their best to value these incurred claims, what they do is they simply create a formula for your total claims for that year. They put a factor in there and they spit it out, and this is what they add to your renewal action to say, oh, well, you've got 10% of your total claims are incurred but not reported. And it's a very fancy way to say this is what the profit is we're going to guarantee ourselves in the next renewal action. Hello. But there's two ways to look at these IBNR claims, and both of these can adversely affect your plan over time. So the untimely reporting of an original claim in the medical plan context, okay, this would be a planned surgery or a condition or accident that resulted in a claim but has not yet been reported. Pretty simple stuff, right? It also can be the subsequent injury from an original claim. So in the medical plan context, again, say that the planned surgery, accident, or condition that we just described was reported, but guess what? There were complications that we don't know about. Had to been, post-operative infection, a readmission rate, something went wrong. I had one case where lady went in for a simple test and they punctured her lung and she stayed a week in the hospital. That would be incurred but not reported because nobody knew it wasn't supposed to be that way. It was a simple test. And they punctured this lady's lung. Lordy. Oh, and they billed her for it. I almost left that part out. So here's the example that we're going to set today. Josh slips and falls and tears his ACL, just tears up his knee, ACL, MCL, and meniscus. Okay, if this injury is not yet reported, it would fall under IBNR, right? It's incurred, but it's not reported. Okay, so let's say we report that injury, and after the injury is reported, Josh receives the surgery, gets the knee fixed, but he develops that post-operative infection and requires a readmission. So here we are. The subsequent ailment stems from the originally reported claim, but until this development is reported, it would factor into IBNR, incurred but not reported. So insurance carriers must account for this IBNR exposure that they carry on their books, and they'll use a range of actuarial services to accurately represent this. A lot of times they'll trot out, hey, we have actuaries that do this for a living, and we know exactly within 5 or 6 plus or minus points of what it means. And on a smaller case, 5 or 6 points isn't that big a deal. But you get into a $5, $10, or $20 million spend, and 5 or 6% of that is real money. So it becomes an important tool to measure and forecast what you're doing going quarter to quarter, 6 months, or year to year out here in your medical plan. So, hey, we say that it's glossed over a lot of times, and for smaller cases it is. But when you get into these large cases, it can have a major impact on what you're doing. So the big deal here too is that in the end, the exposure is added to the actual realized losses. Okay, on a fully insured side, we're going to lose this money. We understand it, but the carriers like to ideally price these accounts to make an underwriting profit. So when they're calculating the IBNR, there's a little fat put in here to guarantee that they are going to be in a positive cash flow position at the end of the contract year. So they charge a premium that is greater than the total loss exposure, including the IBNR. See where I'm going with this, folks? It starts compounding. The more IBNR that they load onto your projection, the better position they are. And look, the standard market, the insureds pay a premium, they transfer the risk to a carrier, and the carrier pays all losses. So if the IBNR realized is less than their forecast, the carrier recognizes that favorable variance and they get to win. It improves the carrier's profitability. When a company self-insures their medical plan, they become an owner of that insurance program. Therefore, if the IBNR is realized less than the forecast, the company will recognize this favorable loss, and they'll improve their profitability. So this is where it's important, because when they forecast IBNR in a traditional model, there's no worry about whether it's up or down, because the insurance carrier is going to take that either way. All right. But when you're self-insured, all of a sudden that IBNR becomes a big deal, because that's pure profit. In self-insured, any way that you cut it, insurance programs are funded with profit. So any insurance premiums or insurance costs that are saved is pure profit back to the business, right? So the IBNR doesn't come in as forecast, it comes in at less, then boom, we are in business with more profit on the bottom line. Da-dun. So that's what we're all about here: benefits, options, and solutions. But we also like to deliver bottom line results in favor of our clients. So here's the deal. Check out www.bettersourcebenefits.com and have a look at the results page that we have for insights on clients that where we've delivered these bottom line results to. Note, these results are permanent savings, and they're in comparison to a fully insured medical program. And of course, while you're in there on the website, if you'd like to book some time with me, John Clay, I'm happy to invest some time to show you how this can be one of the tools in your toolbox to improve the performance of your medical plan, and to restore some and to drive some revenue to your bottom line. So I get kind of excited about breaking apart some of these renewal projections, because at the end of the day, most of them are set up in favor of the insurance companies and not the insureds. So that's it for today. Join us next week, same time, 2 p.m. Eastern, 11 a.m. Pacific, for Benefits with John Clay, and we'll hope to see you out there.